Good day to all of you. I am Rodavia and I am the second lecturer for this group. This video presents about the statement of changes in owner's equity along with the important points you need to know in understanding and preparing this report. Also, I will be discussing about the notes to financial statements and the importance of interim financial statements. But before that, let's have a recap of the previous lecturer. Marvick discussed about the presentation of the financial statements such as the statement of balance position, income statement, and statement of cash flow. At the end of this video, each of us should be able to know and adapt the positions and formats of the statement of changes in owner's equity and understand the importance of notes to FS and interim financial statements. So let us proceed to the introduction. A financial statement is the summary of all financial activities of a company within a specific period. These statements are used to evaluate the good or bad performance of a company. These are classified into four basic financial statements, one of which is the statement of changes in owner's equity. This is found on the final report of the FS. This accounting report shows the changes to the owner's equity that have occurred during the period. These changes are due to withdrawals, contributions, net income, or net loss. How important is this statement? First, the investors engage in investing in the business for a purpose to maximize their wealth. Through this statement, they can know how such wealth is utilized and the flows of such wealth. Second, this statement allows us to see how the equity reported in the balance sheet changes for a specific time of period. Lastly, it allows us to see how the total comprehensive income affects the equity of an entity. To better understand this statement, let's take a look at this example. I have here the statement of changes in owner's equity for the last 5 years from 2012 to 2016. The statement starts with a heading which consists of 3 lines. The first line is the name of the company, the second is the title of the report, and the third is the period covered. For this statement, it is classified into 3 sections, namely the share capital, cumulative earnings or deficit, and accumulated other comprehensive income. For this part is the share capital, which is the money invested by the investors in a business. Then after this is the cumulative earnings, in which you will going to report the balance at beginning of year. Then add the net income to the beginning capital account. Subtract the losses or expenses to arrive at the balance at end of year. To get the total equity, just add all the balance at the end of year for every section in this statement. So let us proceed to the next topic, which is the notes to financial statements. It is located on the annex part of the financial plan report. It contains the info pertaining to a company's operations and financial positions, which are not presented on the face of the FS report. The following are the listed importance of the notes to FS. The first one is they are significant because not all relevant financial info can be communicated through the amounts shown or not shown on the face of the FS. This is done mainly for the sake of clarity because these notes are quite long, and if they were included in the main text, they would cloud the data reported in the FS. Second, it further explains numbers on the FS. The notes to FS provides explanations on how these numbers are calculated. Then lastly, it helps us to understand the definition of the items in the financial report. It is of great importance for the analysts and leaders to read the notes to FS that are included in the company's report. These notes contain information which have material effects on the bottom line return that an investor expects from an investment in the company. Then, let us proceed to the last topic, which is the interim financial statements. As a financial management student, we are recommended to conduct a 5-year financial plan. As we go along with our study, we will be needing the audited financial statements. However, there are times that these statements are not yet ready. So, as a proponent, we should be able to guarantee the interim financial statements. When the financial statements are prepared at any date, even the 12-month period is not yet due, they are called interim financial statements because they are prepared within an interim period of weekly, monthly, quarterly, or semi-annual. Unlike the audited financial statements, these statements are usually audited and condensed, making it to be less reliable due to the shortness of time period. So, the importance of these statements are the following. It gives investors and other users updated information on the company's operation. By looking at the interim FS, the users of accounting information can take a look on a more detailed interim FS. Then the second, this is a big advantage of the interim FS because it can greatly increase the communication between companies and the interest public members. To conclude my video, the statement of changes in owner's equity is very important to the users of accounting information because it allows them to identify the factors that cause changes to the owner's equity. The notes to financial statements give meaning on the numbers and items that are presented in the financial statements. And that's all. Thank you.